Hi brothers, what's up? It's Danny here. Just quick thing. I keep saying DMF Finance, right? It's DM Finance, the Max Finance. That's what the DMF stands for, right? So, quick thing I wanted to talk about today is DRIP, Dividend Reinvestment Plan, or you can say Dividend Reinvestment Program. Some people say program, some people say plan. I mean, it's kind of not really a plan. I feel like you're gonna get the money from it, right? So I spoke about dividend investing before, briefly on the first video, I believe, and a little bit of it on the second video about how when you own a certain amount of shares, it pays you out. It pays you out a certain amount depending on the stock you buy, and eventually you can have enough to buy the shares. I showed that with BGS, which is a Whole Foods company, before, right? So I said I own 50 shares, and then I did the math on how much it pays me out. Since it pays me out 47.5 shares, I think the number was like $23.47. I don't remember exactly, but that's enough to buy me a share currently because it's sitting at $19, right? So on top of what I have, what I'm already buying, when I get paid out, it has enough to buy me a share, right? So if you know anything like about compound interest, right? If you put your money into an account, like a high yielding savings or high yielding checkings account, you get like 2 to 3% back on the money you already have in it just for holding the money in there, right? So with the DRIP method, basically you buy the stock, you hold it, and you allocate it to buy back into the stock. So if I have, like for instance, BGS, 50 shares pay me out $23, and the stock is at $19. When I do get the payout date, the payout I will have one more share, a little bit more than one more share. So it's compounding. It's literally compounding, because it's growing even without me doing anything with it after I already purchased the shares and held on to it long enough, right? So the benefits of DRIP is that it can buy you a share, or if you have a lot of it, a large quantity of shares, and it's a dividend stock, it will pay you out and you can get X amount of shares for X amount of you have, right? So what I say the benefit is, what I believe the benefit of DRIP is the fact that you can buy the shares without you having to buy the shares. You having your money work for you already, right? So what I find, that's a good thing. People that do dividend investing tend to just buy up shares and then do that. Compound interest, this is what I mainly wanted to get into. Compound interest, you're compounding the money that you already have in there without you having to really do anything. This is going to be probably a short video because there's not much to say about DRIP, but you can also allocate it to go into an account. So long term, like if you DRIP for what, 20-30 years on top of whatever you buy, let's say you got 500,000 in the account and you have DRIP on, and say for instance you're still adding to the account as well, but you're not taking any money out of the account, at a 4% rate, I think that's 20,000 that you're getting a year off that account. So that's 20,000 you don't have to invest. You can already have it invested through the DRIP method. So your account basically for that year will grow 20,000, depending on if the stock goes up or down. But you would also have DRIP at the end of that. You can get an annualized return on DRIP. You add that to the actual growth of the portfolio for that. So if you was up 10% and then you add in your dividends, you're up probably more than that, or it could be down to that. That also, you can DRIP. Your DRIP could be a dollar cost average method for you as well. Take it on, take it off. I recommend leave it on. I got mine on all the time and I never take it off, right? So with that being said, I think DRIP is a good thing. Dividend reinvestment plans. A lot of people don't. A lot of people on YouTube talk about it. Like I see it a lot. I've watched it a lot. I watch a lot of YouTube videos, and I thought I would just try my hand at it. Let's see what else. Compound interest. Oh, if you think about DRIP compared to a savings account, or if you have like a compound interest account, right? If you put 10,000, let's go with the number 10,000, onto a stock that drips, let's say the stock is $10. So if it's 10,000 and the stock is $10, $100 you could buy $10,000, you could buy 100, $10,000 you could buy 1,000, right? And if the stock pays you out 50 cents, so with 10 and the stock pays you out 50 cents per share, you're getting $5 back. Well, that's gonna go back into the stock. If you got 100, you're getting $50, and if you got 1,000, you're getting $500 to that stock. So, like I said, if it's if it's quarterly, that means every 3 months you're getting, the first 3 months you're getting 500, right? And then with that 500, if the stock is $10, now you got 10 more shares. So now you would be getting, let's say, 550 or 525, depending on the ratio of what's being paid out, right? So that's money you don't have to add in. You gained $25, $50 without you having to put in any more money. So that's why I find it very important that people put DRIP on, especially if you want to be a dividend-focused investor. We're boring. But really growing up shares, really getting those payouts really help a lot. Like I said, I have 50 shares of BGS, but another stock that I have is called MO. It is Altria Group. Now this stock pays out, I believe, as of this year, 90 cents a share. They usually do a 1 cent increase every year for the last couple of years. I've had it for about 2-3 years. So when I first bought it, it was 88 cents, then it was 89 cents, now it's 90 cents. So I have, let me tell you right now, give me one moment. I'll show you right there. Hurry up and open up phone. Dismiss. Give me 1 second, please. MO. I have 61 shares. And just to fully verify, quote data. Oh, their dividend rate went up 94 cents a share. I'm sorry for that. It's almost $1. So since I have 61 shares, I'm getting close to $61. And the stock current price is $42.49. So if you do the math on that, you take 6 cents off per share. I don't feel like doing that math, but I'm basically getting a share already every time I get paid out every quarter. So for the quarter, I get paid out 4 times, 3 months, 12. So I get paid out 4 times. That's 4 additional shares I'm getting a little over on top of me buying shares, right? So that's why I find DRIP is important. Another example, which I gave already, which would be BGS. Like I said, it's at $19 right now. I have 50 shares. I'm getting paid at about $23. Let's see, another stock that I have that I don't have a lot of it yet, and I have ticker symbol O. Sorry, that's my stomach. If you heard that, I'm a little hungry. Just got off work. Ticker symbol O, which is Realty Income. It's a real estate. It's a REIT, a real estate investment trust, right? And those pay monthly. But a lot of times they're good. Sometimes they pay monthly. Sometimes they pay quarterly. Let me clear that up before I say that. And right now, it pays 24.8 cents a share, right? I only have 3 shares, or 2 shares, my bad, of Realty Income. I'm trying to average down on it, but it's been a stock I seem like, well, I can't really say I have to average up. My position isn't that big yet to really use it as an example, but with 2 shares, I'm getting basically 50 cents. And the stock price is $64. That don't sound like a lot, but say for instance, like I said before, if you get paid every 2 weeks, and you allocate a certain amount of money to it, buy a share every 2 weeks, buy a share every week. You buy a share every week, and there's 52 weeks in a year. That's 52 shares by the end of the year, on top of the little percentages you're getting of an increase of your dividend. That's reinvesting, right? So in order for me to get get to paying off the 62 shares, for it to buy me 2 shares, I believe I need, let's see, 10 shares would give me $2 and $24.80. 100 shares would give me, no, 100 shares would give me $24.80. I'm sorry, and 1,000 shares would get me $240. So I'm just gonna say in that ballpark of around maybe 200 shares in the long term after 3-4 years of doing that. And that don't have to be the only focus. You can focus on other stocks as well. Like I said, putting a certain amount in, being able to only put in what you have, only put in what you are willing to lose and what you can afford. That is the most important thing, period. I'll probably do another video on talking about just like money management. Like, I'm working on it myself. I'm 25, by the way. I'm working on it myself, clearing up my debt and being able to invest more, because the more you can invest, the better your returns is. Period. If you can get a 10% return a year, that's pretty good than a savings account where you're only getting 2% return a year. That means you're getting what? About less than 1% return a month, opposed to getting 0.002% or 0.025% a month. It's a little less than 1%. It's like 0.75% a return a month, and people think that's not a lot. Trust and believe it is. Only a few investment avenues can you get crazy returns like that. Stock market is a good way, especially passively, is a good way to get returns. Like I said before, I want to eventually talk about real estate, but I don't have that on it. That's another way to get really great returns. But that's all I have for Drip. Hope you have a good day, brothers and sisters. Stay blessed.